Good evening, everyone. Thank you for joining us.
More people are
Tonight's
joining in, so let's
yeah.
just keep
But I'd
going.
say we jump in straight away. This time's money. Money's time. Tonight's about SMSF basics, without the noise, and what is why people choose it. Where are the real benefits and responsibilities? And as the saying goes, clarity beats confidence when money is involved. So. Leanne, I'll jump into our first question.
Before that,
And
can I just get Leanne? Can you, if you have not putting you on the spot, but maybe just give a little bit intro about yourself so that people know uh, who is gonna be talking about it and how they are more than qualified to talk about the subject.
Yeah, so a bit about myself. I've, like you, Rahul said, I've been in self-managed super funds for over 20 years. I'm an accountant, a chartered accountant by trade. Uh, but what I help clients do is set up super funds all the way through to maintaining their super funds year on year to until they get to retirement, work on strategies on how to access those retirement benefits, and then eventually we wind up super funds. So I see the entire life cycle, and that's what I do.
Excellent. Thanks for the intro. Quite impressive. Yes, Ashish, you can start with the question.
Rahul, before we start, I think the difference we've seen is Rahul going from the Lenders Club to Fin Matters. So, what is Fin Matters, Rahul?
Matters is the place that I started because I truly believe, and the logo also is the same, your finance matters. So even before that, I always thought that, clients, their finances should matter and we have to be attentive to pick up calls on time. If clients are working 9 to 5 and they get time after 5 p.m., 6 p.m., there should be someone who is available to pick up the calls and answer the questions and truly do every simple loan as if they are doing their own loan, which is what I do and which is my team of brokers do as well. And that's why Fin matters.
Awesome. I think I should rename to Property Matters as well. Um, Awesome. All right. I'd jump right into the call. Even though I and Rahul Leanne have been conducting these sessions for now almost 4 5 months, and we try to bring in professionals who can add value to the client's journey. At the end of the day, it's all about education. We've got about 90 something registrations, so hopefully we'll see a better turnout. But again, 30 people are more than enough at this stage. So look, so tell me about this SMSF get rich quick schemes. What is this all about?
Oh, I hate seeing um, so many little shorts and videos on all those social media platforms with let's get rich quick and access your super now. You only need 20,000 to start your self-managed super fund. Yeah, and these are coming from people who are looking for clicks. They're not real advisors. They're not people who have been in the profession for years. And when it comes to self-managed super funds, you're dealing with a lot of money. It's your retirement savings. And so you got to take it seriously. It's not, let's take out 10 grand and go on a holiday. Um, you actually are accountable. And it's so important that you understand the rules around self-managed super funds. It's not just another bank account. Um, and otherwise, you are jeopardizing your future.
Amazing. And I've heard that because we do developments as well. And when people put their super money, that makes developers or people accountable because that money will be used for their future. So, can we start a little bit around what is SMSF, around the structure that we start, and what is involved in creation of SMSF, please?
Yep. So self-managed super funds are effective, like all understand the concept of superannuation, right? This is a retirement savings. So self-managed super fund is just a private superannuation fund. So think of Australian super, but small, and it's just for you and the people who are in your SMSF. You can have up from you can have up to 6 people in your SMSF. So you can combine people's balances to build up your SMSF and then invest together, or you can run it on your own. So self-managed super funds still have the same goal, which is for your retirement. It's not to access your money now.
And why should they do this? Like, let's say there's industry supers out there. Those people should know what they're doing, right? Because they are big institutions. So why should someone do SMSF? What's the benefit of that? And why do people do that? So can you please talk to that?
Yeah, so um, why someone would set up a self-managed super fund over keeping it in an industry or retail fund is that you get greater control and transparency. That's one of the main reasons why people look into self-managed super funds. When you look at your member balance from a member statement from one of your own, from a retail or industry fund, you don't know what went into those numbers. What have you invested in? How much have you been paying in fees? Um, but once you've got a self-managed super fund, you see every dollar that comes in and every dollar that goes out because you're in control. Um, so not only do you get control and transparency, you get access to investing in things that you don't normally get to in those funds. So things like direct property, you can't do inside those industry and retail funds. So um, it's a great vehicle or great structure, so long as you understand that you are maintaining it for your future self. So
And I
Well said.
see,
And I'm just a finance guy. I just understand numbers. I see in my super returns that I get are 8% and 10%, whatever the number it says, but after the fees and whatever charges, it basically comes down to 7.5% at best. Which I feel like if I can get better returns somewhere and I can control the funds, invest in property, and 100,000, 6, 7% after that, whatever that number may be, by putting 100,000, 150,000 in a property, if I can get I buy a property worth 600,000 from that, and I get 10% return on a 600,000 property, then on a 6% on 100,000. That's where the difference for me comes down, because 60,000, 6,000 is the key difference between why people do the SMSF setups, why they invest through themselves rather than just putting someone else control your money and they invest for you.
that's
That's my
exactly it.
reasoning for that.
Exactly,
so
you've hit the nail on the head there. Um, it's a question of can you do better than what the other funds are doing, and whether you can back yourself on those decisions.
So, Leanne, that's very well said, but that's talking about property, and I see a lot of property spookers in SMSF. So, not talking about property, what I'd love to understand 2 points, considering, look, SMSF is general, right? I know,
Mm.
as Rahul said, he's a finance person, I'm a property person, so we have a one-track mind, which doesn't deviates much. But I'd love to understand 2 points. Number one, and I don't know if you're the right person or we can delve into those questions. So number one, what other investments we can have under SMSF? And
Mm.
number two, the risks. So we talk about advantages and benefits, but the risks of having SMSF as well, please.
Yep. Okay, let's talk about those investment options. So when it comes to self-managed super funds, almost anything is possible, so long as it's sort of you comply with certain rules. So you can have ASX listed shares, pretty ordinary, ETFs like things like Vanguard and Beta shares and all those wonderful exchange traded funds, which have sort of grown in popularity, especially in the last 2 to 3 years. Um, you can go into normal managed funds, unlisted unit trust, property trust. So there's different types of property, not just direct property. You can go into property trusts. Um, and I've seen some really funky other investments like cryptocurrency. Not a huge fan, but that's neither here nor there. But things like collectibles, I've seen some really interesting collectibles that have gone through the roof, especially during COVID when um, secondhand cars were going gangbusters. So the collectible cars, um, artwork. I haven't seen too much of it. Um, but watches, I've seen lots of interesting watches. But there are just rules around these potential investments, and you have to always remember it needs to be with the investment mindset, not okay, I can wear this watch or drive that car.
Very good point. And
You had me.
yes, sorry, Rahul.
No, that's what I
This
was saying, that this is why, people qualified such as Leanne should be able to talk about these things, because when you hear about on social media, when you hear about whatever influencers talking about that, they don't give you this side of things, that you should not be doing under SMSF, because it's a highly regulated space. It's people's retirement money, and if you just put borrow under SMSF or whatever, you put the transfer roll over the funds, get into SMSF, and then put it on all black, hoping it to get developed. That doesn't work that way.
and I track some investment vehicles, no expert, but I track art, and the depreciation rules around it are very lucrative. And I never gave a thought that using SMSF, there's those options as well. Plus, I've recently seen people can loan that amount as well, and a lot of big developers provide anywhere between 12% to 15% returns on the
Mm.
money invested as well. But as the name suggests, of course, it's self-managed. What risks it brings to the table, Liam?
Well, because you are self-managed, as the trustee making all the decisions, you have you are responsible for managing your investments. You are responsible and accountable to the Australian Taxation Office, who is the regulator, um, and all that encompasses. So if you break the rules, there are penalties, there are fines, um, and potentially disqualification, which may affect, in the most serious cases, you can't be a director of another company like your own business. So um, it is quite severe if you get it wrong. Um, so not just the investment risk, which most people tend to focus on.
And sometimes, I'm sorry, I'm just asking so many questions. I know I'm
No,
being
great.
very inquisitive, but there's something called yearly audits in SMSF as well,
Mm.
and they define whether the SMSF is compliant or not compliant. And if it is not compliant, I think that's where you're referring to severe penalties and consequences. Um,
That's that's right. So each year, just like a business, you would have to prepare financial statements and tax returns. And with those accounts and tax returns, they need to be audited independently. And that's a requirement by the regulator. It's kind of doing the tax office's bidding. They're going off a checklist, and there's a series of legislation and regulations that they check against. And if you breach one of those items, that's reported to the tax office, and that can open up things like a review or a questionnaire by the tax office, or potentially even an audit um, from the regulator, and that's quite serious. So you don't want to be in that position, which is why you work with professionals who know self-managed super funds, and there's a whole range of professionals that support you. Even though the word is self-managed, there's actually a big team that you need on board to support you and help you stay compliant. And as a trustee of a super fund, you need to make sure that you're asking the question before you go and do the thing that you think you're of doing.
Well said. Again, as you mentioned, it's a teamwork. Even though the name is self-managed, but it requires the whole team, starting from the mortgage broker to your accountant, to someone who's going to set up the SMSF, a financial planner to give the advisor on a buyer's agent to buy the property, the depreciation experts later down the line that you need to do all the calculations. So on the same thing, because it's so confusing, then how do we start? What should be the process that you recommend? I have my own method, which I tell my clients what to do when they talk to me about SMSF. But I want to hear from you that for investors, especially for property, because a lot of the clients are into property, even the listeners. So how should they go about into that? What is the minimum balance that they need? So can you answer? Would you be able to answer that? Or I can talk from the property side of things that how much do they need to buy a property? But then I want to hear from you. And then if you want me to, then I can just chip in about the how much deposit would they need, how much funds they need in super.
Yeah. Yeah, so the ASIC who actually manages financial products, they oversee the financial products. They actually recommend at least 250,000 to 500,000 as a minimum base for a self-managed super fund. And the only reason why they say that is based on costs and of management, annual management. But in saying that, there is actually no minimum requirement to have inside a self-managed super fund. So if you have plans to sort of step your balance up to that level, and and you have a great investment strategy, then you can always start with a little less than what the regulators are recommending.
It's a
And that kind of
recommendation. It is just a recommendation. Is it a rule or is it a recommendation that?
it's a recommendation. It's a
Okay.
recommendation. Yeah.
Yeah,
And
because I
so,
have seen people and a lot of clients as well. She would have seen,
oh,
sorry to cut you off, that
yeah.
even with like 120, 130, $150,000 in the super, they have been able to buy the property and just do it comfortably and make profits on that because all you need from the lending perspective is the deposit funds that you need for buying the property. In this climate, there is no liquidity test. There is no a lot of the lenders don't have the liquidity test, which they used to have, which means that you need to have at least surplus amount after buying all the properties of 10,000, 20,000, $30,000. Now, lenders don't have that. Previously, you need hefty deposits, 20%, 30%. These days, even with 10%, you are able to buy a property under super funds with the stamp duty and all other costs involved. So if you look at just recommendation and if you still wanted to do that, all you need is just the deposit money plus the cost involved to buy a property.
Yep, yep. I- so in terms of minimum balances, that does make sense. However, it's really important that you don't stress yourself with the cash flow. There are things that come up that when with all properties, you never know when something sort of breaks. So you need to be able to fund that. And that's where from my perspective, when it comes to buying property inside self-managed super funds, and if you plan to borrow to buy property, the first step I actually tell clients is talk to a mortgage broker because you need to understand your capacity before you go out shopping to buy a property or setting up your self-managed super fund, which can be quite a costly exercise in itself. So sort of educate yourself first before diving straight in.
Well said. I mean, again, no finance advice. This is just what is
Yeah.
possible. It's just a regulation recommendation from ASIC about that. Also, I see some people raising hands and asking questions. So you can post all the questions in the chat and we will take it in the end. So feel free to ask as many questions as you can and we will try to cover all of them before this ends. Yes, Kunal, we also see you have raised your hand. So maybe if you just put in the chat box and we will cover that topic and answer your question. And yeah, sorry, coming back again, the same thing, the stepwise process. Come to the mortgage broker before you spend money on setting up the SMSF because once we determine the budget and the eligibility, that's when, and if it fits your strategy, that's when you can go ahead and spend 3-4 thousand because 3-4 thousand, whatever the money that's needed to set up for SMSF, it's not cheap. There are compliance annual cost as well. So once that strategy, the budget fits your strategy, that's when you can go ahead and spend the money, set up the SMSF trust, the Bayer trust, whatever you would do for them. And then second step, once the SMSF is set up, while the funds are being rolled over, we can do a pre-approval for you. And then once the pre-approval is done, simultaneously the funds are also rolled over. So that's step number two. When that is done, that's when you go ahead and start looking for properties or talk to your buyers agents such as Ashish, and they can find you the right properties, and then we proceed with the settlements. So that is the process that I usually refer to my clients. But yeah, I mean, just to on the same point, if you had anything to add on that, Ashish, yeah.
Yeah, so look, I start explaining the structure, Leanne. So I know there are few trusts involved and advice involved. But then again, I'd love for you to explain how does these structures work and the way you will explain structures to your clients, please.
Yeah. So the basic superannuation self-managed super fund usually involves two types of trustees. So you can either be a minimum of two individual trustees, or you can have a company trustee, which is probably the more preferred option, especially when you are borrowing to buy property. So the trustee's role is to make all the decisions for the fund. And as members of your super fund, you all have to be part of that trustee group. So if it's a company, you would be directors of that company. So that's the basic structure of a self-managed super fund. But where it gets more complicated is if you decide to borrow to purchase a property. And the reason why it gets more complicated is technically super funds are not allowed to borrow directly. So the way around it is what they call a limited recourse borrowing arrangement. And what that is you set up another entity called a bare trust. And what the bare trust does is it holds the property until you pay out that loan. And what it effectively does is it's kind of like an asset protection mechanism. So it fences off the property and the loan away from the rest of your super fund assets. So if you default and the lender needs to sell the property or get its security back or gets its money back, it can only take the property. It can't take, if you have diversified and invested in shares or that fancy watch that is sitting in a safe somewhere, it can't touch that. It can only touch that property. And so that's why we set up this bare trust. And with that bare trust, another trustee and again, a corporate trustee is preferred there.
And that's a very wonderful explanation. Um, as I also understand, and I know this is not a conveyance or solicitor conversation, but Rahul, as I understand, when you do the loans, you need a solicitor advice as well. So ideally, I would say rather than having a conveyancer and then having extra solicitor, it's always good to go with a solicitor if someone chooses to purchase a property through that. Is that right?
Yes. So traditionally, because it is what we call independent legal advice, when Jonathan, the solicitor, back in the webinar, he gave a really good explanation as to why it's needed and what does it mean. So basically, just to recap, what he said was that independent legal advice, there was an incident long when the people who borrowed money through the trust structures, they did not understand that they are the guarantor and they still have to pay if something goes wrong. And they actually went default. They actually went. They defaulted on the payments, and bank was not able to recoup the money because they were not able to prove that they understood the arrangement. So now since then, the process of independent legal advice came into process because under trust, SMSF doesn't matter what sort of company structures you are borrowing under, you are the guarantor. You still have to make the repayments on that. You can't default on that. You are still the guarantor. So they have to take legal advice. This is what the legal advice. I, again, don't mean to give any legal advice, but this is technically in short what the
Makes
legal
sense.
advice comprises of, and they have to get it from the solicitor or a lawyer, and they have to uh, confirm that they have done that before they get the loans. So that is usually a settlement condition when we do the mortgages.
Yep. And Rahul, in addition, talking about the lending, there were 80 strictly, I believe, 80% LVRs that were being maintained. I've heard SMSF these days also allow 90% LVR with LMI. Is that right?
Yes. So again, there's a question about this as well. Did want to touch upon that. These days we have lenders who can do with 10% deposit as well. Some of them do charge an LMI protection fee, which could be 2%. Some of them don't even do that. So these days, with 10%, you can buy, property as long as the borrowing capacity is there. Because with 10%, the rates are also a little bit higher. But then there are deep down a little bit some benefits for that, because when it comes to lending, we will cover this topic after that, the do's and don'ts of what we can do and what we can't do in SMSF. That's when I will touch upon this again. But in short, yeah, you just need 10% at least these days to do that. Some lenders, that being said, do have a minimum deposit or minimum um, criteria of what you should under the SMSF, or minimum SMSF balance, which is 150,000. But some don't even have that. So yes, less than 20 is fine these days.
I remember buying a villa worth, I think 380K in Perth. With SMSF balance, that was around 135. And I kept on asking, you sure you're investing in property, right? And I said, yes, Ashish, why would you ask that? I said, okay, no worries, just wanted to confirm. But Rahul, as I also understand, so before we go to the negative gearing and benefits, Leanne, Rahul, just one last question. As I understand, because a lot of times people ask what kind of property we should buy, and I believe we can take this at the very end, just so Leanne can focus on SMSF. But one question, like there are some lending restrictions as well when it comes to lending under SMSF for property. Like as I understand, you're not paid for any renovations, you can't withdraw equity. So just can you touch a little bit on that, just in a very short 2 or 3 sentences, please?
So lenders would not lend if you have to do any structural renovations, any major renovations. If you have to do development on that, they can't do that. If you want to pull out equity, do cash out, refinance, and pull money out to do any other purpose other than a little bit of cosmetic repairs, you can't do that. So there are a lot of restrictions when it comes to SMSF from lending point of view. But this is broadly speaking the don'ts of that. People can still buy commercial property, people can still buy commercial property and rent it to them. You can't live in the property, again, some of the don'ts of that, but you can rent it out to yourself if it's an office space or one of those. Sorry,
Well,
go
I'm
on.
sitting in an office space that has been bought through my SMSF. But as everyone says, it is an arm's length transaction. So, Leanne, over to you. Um, like, how does business owners can buy properties under their SMSF for their own occupancy, and is that even possible?
Yeah, that's one of my favorite strategies inside self-managed super fund, and congratulations to for Ashish for doing that
I like
because I
how it made
think
you so happy.
I love it because why are you paying someone else rent? Isn't it wonderful that you are paying yourself the rent for your own office space? So what the terminology is called business real property. And what that is the ability to have your self-managed super fund to own property, real property that is used for business. So and with that, there's an exception inside the legislation that says that if this property is wholly and exclusively for business use, you can actually lease it to your own business, to your related party business. You can't do that with residential property, even if you're paying market rents. But there's just this one carve out because they, when they developed this piece of legislation, they understood that small businesses actually have a lot of their retirement savings inside their business premises. So um, I do think that this is one of the best strategies where you can pay market rent to your super fund, and then being able to get some tax deductions on the way through, and then being able to have this beautiful asset at the end when you do retire.
Amazing. And look, moving out of property a little bit and just generalization, different concepts in SMSF. Leanne, I'd love to talk about your insights on depreciation, negative gearing, capital gains tax benefits, or land tax in
Thanks. What are the
property.
benefits of SMSF in
Yeah,
that?
within SMSF, please.
Okay, tax. Okay.
Yeah,
I,
because I was going through your feed and all I saw was negative gearing benefits, land tax benefits. Even I got confused. I'm like, okay, let's again speak about that and that should clarify our doubts.
okay, so let's start with the basics. So self-managed super funds, like every other super fund, they have an earnings tax of 15%, which is already a lot less than what we pay as marginal tax rates for us personally. So with that 15% earnings tax, when we buy and sell assets and make a capital gain, um, personally, we get a 50% discount if we hold it for more than 12 months, right? So, but with a super fund, we get a 1/3 discount. So if you hold it for more than 12 months, you get a capital gains discount of 1/3. So you end up paying 10% tax on any capital gain. Still pretty attractive. So that's capital gains tax. Um, but once you sort of move into retirement phase, so we're talking, when you turn 65 and you've decided to stop, or you turn 60 and you stop working, you can go into what they call retirement phase. And with that, earnings tax becomes 0%. So if you get to that, when you get to that point, when you sell that property or you collect that rent, if that if that super fund is helping support a pension or a payment to you, an income stream, you get a concession of zero tax on all that earnings, which is pretty exciting stuff. So that's earnings tax. Um,
Hmm.
yeah, when we're talking negative gearing, on the other hand, so
Sorry,
we're
just
going, yeah,
a
go back.
question on tax. So, if I understood correctly, you said first within the period when we haven't reached a certain age or maturity, we are taxed at 10%, but
15%.
yes, 15%, sorry, 1/3. Now, is there a concept where SMSF is compliant? This is further slashed by 33%?
Oh, so you're talking,
Capital
sorry.
gains tax.
Yeah, so capital gains tax, you lose, so 15% earnings tax, and then capital gains, you get a discount. If you hold it for more than 12 months, you get 1/3 off, so you end up paying 10% tax on capital
Understood.
gains.
Yeah, I
And you
hope that
also
answers Jaskaran's
mentioned,
question. Jaskaran, if it doesn't answer your question, let me know. We can revisit that.
I think, Raul, we can
So I think,
revisit the questions at the end, just while the
yeah, no, because
conversation's
it
going.
was like, the
Oh,
question
okay.
is that 1/3. So
Ah,
we will not
yes, I
understand
saw it.
what is it about. So yeah.
I saw it.
Yeah, so
So
33% of 15% is 5%, so then you end up with,
10.
15 minus 5 is 10. Yeah.
Absolutely. We'll
Sorry, I
write it.
jumped a few steps.
And if I understood correctly, as soon as the SMSF matures, at that time there is no earnings tax and no capital gains tax, or I just assumed stuff.
Yeah, so your balance, um, so long as it's, so for a certain amount of your balance, what they call the transfer balance cap. Currently, it's $2 million. You can have $2 million in retirement phase, earning 0% tax, making, so that's a lot of money to be tax free. And
hmm,
I love it when people turn 60, because once they turn 60, it opens up a whole new world of opportunities when it comes to tax strategies. And because the money you draw out from super is tax free, and the money that you earn inside your super fund also is tax free.
But I
So this
think,
is as close to a tax haven as you can possibly get in Australia.
and that's $2 million per partner in SMSF.
That's right. It's per person. So it's not necessarily in an SMSF, but just generally in super. So you could potentially have multiple super funds all in this phase, up to $2 million as of today.
Amazing. And
that's,
provided, yeah, sorry, Rahul.
I'm just saying that's index until retirement. Is it
That's
not?
right.
Yes,
It
and
is
then
indexed. Yeah.
over to you, Leanne.
This it is indexed, and these rules do change over time. Um, in fact, there's a piece of legislation that got introduced to Parliament today, that is taxing high balances. So people, with we're talking 3 million, 5 million, 10 million, these are big balances. So watch this space. Tax in super always changes.
Got it, got it, got it. But yeah, on that note, is there anything about depreciation or land tax that
Mm.
we can cover in this?
Absolutely. So when you're owning property inside your self-managed super fund, there's lots of other benefits inside and taxes related to it. So land tax is one thing that tends to get a lot of attraction, especially inside in New South Wales, because our land values are through the roof in New South Wales. Um, but one of the benefits is that a self-managed super fund is a special kind of trust from a Revenue New South Wales point of view. And so we get to access a land tax threshold. So potentially, if you've got properties outside super and you've already hit that threshold, setting up a super fund and buying your next property, you open up another threshold. So you may not need to pay as much land tax. Um, and when it comes
Such a
to,
good, I'm just saying, such a
yeah,
good hack, if hack is the right word for this, to get around the land tax rules. Because land tax can be so heavy.
yeah, and it's a tax on something that you're not selling. It's not something that's generating cash to then pay a tax. So it's an unfortunate tax. It's a nasty one. Uh, but each state has their own land tax. But it does seem to hurt a little more in New South Wales, from what I understand.
Yeah. Uh, no, I got that. So on that, I also wanted to ask Ashish about properties. Like, what sort of properties under SMSF should clients target? Especially, let's start with residentials. Is there a like sort of a criteria that they should be higher yield or should be closer to capital cities? Is there something, or is this just a myth?
Look, again, I think we need to touch upon the holding costs, but the rates are slightly higher as well. So ideally, it's again a strategy. It's either growth oriented or cash flow, depending upon the balance, income, and other things. So, but when we look at residential, we definitely have to consider we are focusing on a low maintenance property rather than a high maintenance. Because if there's a major expense, no one's paying you but you from your pocket. And honestly, for me, SMSF is a pit where the money goes, never comes back. So, I mean, you can plan to put in more. And then if you have high income, the property is cheaper, you pay it off fairly quickly, you do whatever you want. So you keep that in mind with what you buy. A lot of people would think I can do subdivision, but you're not paid for subdivision unless you've paid off the property. So you're waiting a good 8 to 10 years or 7 to 10 years based upon the income. So I'd look at a low maintenance property, fairly newish anyway. So my policy is less than 15, 20 years old. So if your holding period is 15, 20 years, before a major expense comes, you can get rid of the property, just depending upon the risk appetite. Like
Mhm.
I bought this office and then I bought another residential, which was about 8 years old, nine maybe. So assuming I would hold for another 8 to 10 years, there's very least maintenance to be paid. Now that's residential. Then there's an option of having commercial, and ideally, I like the commercial rates in SMSF than actually outside of SMSF. So commercial works in a much better way, but a lot of buyers then again try to chase yields more than anything else. Apologies for the sun. You can wear your sunglasses. So So in order to chase the yields, a lot of buyers will then go to regional areas in the middle of nowhere. I'd be very careful with commercial there because your vacancies would go up. So I'd still cover some risks, but with 80% LVR and a 5.5 to 6% yields, you're fairly breaking even there, even with 7-ish% rates. And that's the beauty of having commercial. Now, this office might not make a lot of financial sense or numbers sense, but as Leanne mentioned, it is my own property, and I'm a rent investor, so I don't see the value in buying a home, but I see the value in having a permanent address for business. It's just the way, it's just that suits my strategy, longer term strategy. So commercial properties I bought in SMSF, I bought residential properties in SMSF, and with Leanne, I don't know your situation, but coming first generation migrants migrating to Australia at the age of 30 to 40, it takes about 5 to 7 years before even we see the balance to 180 to 220. And then we've got another 10, 15, 20 years. But in order to expedite, and that's where the leverage kicks in, and the property sometimes makes much more financial sense than any other vehicle. And not that I'm an
No, so
expert
that's a
in any
really
other
good
vehicle.
point, and because you mentioned strategies as well, this is what our next point also is. Like, that's a great strategy that you implemented for yourself. And again, like, what other strategies can investors use to utilize SMSF to the max? So, Ashish and Leanne, if you both like can comment on that, because you would have dealt with a lot of SMSF investor clients, be in terms of property, and Leanne, especially you in every different aspect as well. So maybe if you both can touch up on that a little bit.
Um,
Like one
Let
of
me
the
think.
strategies, as you mentioned, was to buy a property and rent it out to yourself for commercial users. Is there any other strategies that clients can use that you can think of off the top of your head?
Um, so the standard property, buying property for your own investment, that's solid, right? That is a solid strategy in itself. When we're starting to get a little bit quirky, um, things can get very interesting, but um, it's it can be really rewarding. So, Ashish, you mentioned rent vesting. And one of the things that I hear often from clients is, I can't afford a property outside of super, but I've been working for so long, I've got a decent amount for an investment inside superannuation. So, one way to get into the property market is to take into account your superannuation balance, and it forms part of your overarching investment strategy. So you can't think of your superannuation on its own. I think you need to think about your whole wealth as a big strategy in itself. So diversifying and using your super to get into the market when you can't do it outside of super. That is one way people are investing. Other things that I've seen which are really interesting is buying that dream home, that retirement home inside superannuation, um, which is a weird concept because you're not allowed to live in your home in the property that you own inside your super fund. But what if you get to retirement age and you like the property that you had invested in? It's done really well. You've paid it off over time. You've managed to keep it really nice. So, and you want to go and retire in that spot. So one way is to transfer that property out, use all the tax exemptions and tax things that you can do when you've retired, pay stamp duty on the way out, but you get to live in your dream home, the home that you had purchased way back
Mm.
when you started your SMSF journey. So I thought that was an interesting strategy. Yeah.
For sure. No, definitely. It's very out of the box as well because not a lot of
Yeah.
people do that. And that's when you actually, when you get to the retirement, when you have seen everything and you are just exiting, that's when these things can like show their true effect. That's when the benefit of SMSF like truly kicks in.
Yeah. So you have somewhat locked in today's prices for 20 years time when you retire, in a weird way. Uh, it's not for everyone, and it's definitely in very limited circumstances, but that that's a different way of thinking about property inside self-managed super funds.
Right. Ashish, do you have anything on that?
Not really. Look, I'm no expert in building strategies within super,
Well,
but
you're a bias agent, that's what you do.
property strategies, yes. Super
Yeah,
strategies, no.
no,
So
absolutely.
I can share one experience which the client came from a financial planner saying he needs a 650K property. The balance was, I believe, around 300. We bought a property in Queensland around 650 at that stage. And recently, I believe, mid 2025, they ended up selling that for 900. And with 750 what they had in their super and some extra contribution, the husband and wife are at this stage late 30s. They're smashing their contributions to the maximum limits. Right now what they've done is they bought a $2.1 million commercial property which at this stage is returning about 120,000 in rent. So I liked because they've got a good 18 to 20 years at least behind them. And at 4%, this rent is going to double. So with just this one property, the guesstimate is that they'd be getting about 240,000 in rent and the property would double. But then again, what's the point of the value? Because the focus turns to income eventually. So I really liked what they implemented, of course, with the advice of their planner. But um, that's that again, this can be done in personal as well. But in personal, of course, you smash through taxes and whatnot. That's one strategy, not strategy, but that's one experience that I felt was very
So basically,
life-changing,
what you're
I'd say.
saying, don't reinvent the wheel. Leanne has mentioned that, diversify and try to think beyond like what's going to happen in retirement and try to take all the tax benefits of the superannuation and the SMSF that allows you to do that. So these would be the key takeaways from this topic that we have.
Yeah,
Well,
just sorry. Yeah, you go.
oh, I, I was going to say, we touched on one of your questions was negative gearing inside self-managed super funds, and there's a lot of talk around that as a potential strategy for your self-managed super fund and buying property and things like that. And my only commentary on that is negative gearing's great outside of super because our tax rates are so high outside of superannuation. And so the effects of negative gearing to offset your other income, like maybe salary and wages or other investment income, it has a greater effect than inside self-managed super funds or super in general, because that that offset of expenses from the property, um, that if it goes into negative, you're only getting a 15% effect because the tax rate is only 15%.
Mm.
And when you're talking about property inside super and paying off a loan, you actually want the property to somewhat be positive gearing because you want to pay that loan down and so that you can start building up your super wealth. So negative gearing doesn't isn't really much of a focus inside self-managed super funds, but initially it may be beneficial. So if usually in the first couple of years you are negative, right? I'm sure Rahul, you've crunched the numbers.
Especially
It's
in these interest rates, yeah, absolutely. Even with
yeah,
interest-only repayments, some people do that for short term for initial hard period when their cash flow is going to be tight. Even then, even with interest only, the repayments are so high, property cost, the management costs are so high that most properties are negatively geared in this climate.
yeah, so in those first few years when you are so negative, you can offset that negative returns with your super contributions. So if you've got employer contributions going inside your super fund, you are ta being taxed at 15% on those salary super guarantee amounts. So that negative gearing does actually have some effect with other income being super contributions. So if you really want to take it to the next level of strategy here, um, what about salary sacrifice? Building up that super contribution, reducing your personal income, making deductible contributions and offsetting those losses inside your super to to help bring down that loan and keep building that wealth inside SMSF.
And the threshold for that is 30,000 for one person.
That's right. It is rumored to increase with indexation next from 1 July, but that's still just a rumor.
Got it. So they can make up to 30,000 total contributions under the SMSF within the same tax bracket.
That's
And
right.
after that, non-consistent contributions, tax liability belongs to either the super fund or with the industry. That's my understanding, at least. Got it. The next point is what. So we discussed what we can do with the SMSF, but the next one would be what we can't do under the SMSF. So yeah, Leanne, you are the expert on that. Please take us through that.
Okay. Number one thing is you can't take that money out and use it for personal use. So
Damn
that's
it.
number one thing. You
Yes.
can't get your financial benefit and go on that holiday. Um,
Yeah, I
it's
find that ODRSA really empty.
It's retirement.
I have had someone come up to me and go, if I create a super fund and roll it over, take out that money, go on a really big trip, and then put that money back, does that work? And I go, no, it
Yeah, immediate
you've
non-compliant
breached it.
notice from ATO.
That's right. So we touched on it earlier. You can't live in a property or use a property, or use an investment. So let's not restrict ourselves to property. If you've got some other physical asset, um, that you can't use it, live in it, enjoy it, take any financial benefit out of your super fund until you are eligible to actually take out that benefit. You can't then have a relative do the same thing. So you can't have a brother, sister, niece, nephew, cousin, aunt, uncle live in a property or use your assets or even, you know, in-laws, no go. So relatives, even if they pay you market rates for any of this, you can't do with the exception of business real property. Um, you can't give financial assistance to members or their relatives, so you can't loan them money. Um, that when you go into financial strife, and you see this bucket of money inside your super fund, you can't, even if they give you a great interest rate, you can't lend a relative or yourself money. So there's a lot of things that you can do, but it's very clear that if you can see that it's a benefit to you, a financial benefit, then you're probably doing something wrong, like
Yeah,
a personal
makes sense.
benefit.
And also from lending side of things, I think that some of the things which need to be clarified that you can't pull out equity from that as you can do outside of SMSF, even in a different trust, you can do that, but the SMSF to buy a different property. So you can't do it under the SMSF. That's why I was mentioning that initial 10% deposit or 20% as low as you can put in to get the property. That's what, if your goal is to keep buying properties or use your funds to the maximum, maybe try to put a little deposit, as little as you can, so that you can use the rest of the funds down the line to buy a second property or use invest in stocks or whatever other goals you have under the super. And then again, you can't do developments in that. You can't buy, like you can technically buy off the plan existing property, but you can't buy land and build on that. Again, lenders would not lend for vacant land as well. So you can buy it technically as I said outright, but you can't borrow money from a lender for that. So these are some of the things that I can think of from SMSF lending point of view. Again, there are a few more which I can't remember now. But what you can have, which a lot of people don't know, is you can have an offset account these days with SMSF. Some of the lenders have started to allow that. Again, a little bit of a murky area because the main issue is that you can't use the funds for development or construction. And if the money is in offset, you don't know what the funds are going to be used for. So some lenders don't allow that, but a lot of lenders have started to provide offset facility. So you put, let's say 10, 20% deposit towards the property to buy it. And then you still have some excess funds left over. You can park into your offset and save the interest on that. So again, one more strategy that people use. to minimize the interest on the loans.
So just
Uh,
in addition, sorry, just from a property standpoint, yes, Rahul, you're right. You cannot buy land and build on it, which means a house and a land package. So, but unless it's a single contract, and something that I'd like to highlight as a caution, in order to prepare that single contract, someone will settle the land, they'll do the build, you'd be charged the stamp duty again, and the interest is paid by that person. So he'll charge you on everything, plus he'll add another $10,000 to $20,000 as a fee. So ideally, you'd be paying about 8 to 12% extra on that one contract. So it's not the best strategy. On top, going with developers or developments, you can't have shareholding in SMSF. It has to be a fixed interest, which means you can only loan to the developer, provided you're not part of that development in shareholding. And I think that's where the arm's length transaction comes in. Something that I've just experienced recently in one of our developments. Over to you, Leanne.
yeah, I was going to say, I've seen instances where people think, okay, I'll use my super money and buy that vacant piece of land because I can't borrow to buy that land, and then they come and say, okay, I need to now get finance to build on it. And you can't you can't actually go and get finance to then build on a piece of land, even though you already own that property or that own that vacant land. So that's one of the big no-nos, and you end up being stuck with a piece of land with nothing that you can do with. Um, but I want to go back to Rahul. You mentioned offset accounts, and I actually came across a horror story. If you don't mind me sharing a little horror
No,
story
please.
with an
That was also
offset
the next
account.
point. The consequences of doing things wrong in that SMSF. Please go ahead. Let's get started. We love
Yeah,
we
so
love horror stories.
I love sharing war stories with you.
Very
Um,
easy.
so uh, with an offset account, many of these lenders that you work with, they're not considered banks, technically banks, right?
Yes,
So,
authorized deposit taking institutions. But yeah,
yep, see, you know the technical words for all this.
it's
Um,
a little bit of
so,
showing off going on.
so because they're not technically those ADIs, um, the offset accounts are also not considered bank deposit accounts. They're actually considered sub accounts of those loans. So while they're useful, um, especially when it comes to parking money for repairs and maintenance, loan repayments, and things like that. The horror story was that they had saved up all this money and was sitting in the offset account, and this super fund trustee decided to take that money and put it as a deposit for another property. That's the reaction we want.
Yeah. Oh my God. So they used the deposit which was sitting in the offset account to buy a property, different property,
Uh, yeah, so
under the
you get to a
SMSF or
point
outside of SMSF.
inside the SMSF. So that obviously that's your goal, right? You want to build your property portfolio inside your super fund. But because it's a withdrawal from an offset account, the rules around that offset account were quite strict. And that was actually technically not allowed. So you couldn't use that money that had been saved up in that offset account to buy the next property. Yeah.
Interesting. That's what people do a lot. I've
That is
never seen.
interesting. Yes, I'd like to just,
Yeah.
if you can
So
elaborate
what
on
happened
that.
after that? Can you please tell me what? Maybe
Yeah.
after that you can tell me as well. I'm
Yeah.
more than
So,
happy to for everyone to understand and see what what. This is new for me as well because this is what people do almost all the time.
yeah, and 99% of the time when you have an offset account, which is usually outside of self-managed super fund, that's perfectly fine. There's no problems with that. It's just that with the super fund rules, it's actually considered it it's it's in that murky land that you were talking about. That is it a is it a redraw? Is it
That's what I see. Redraw is different because redraw is a problem. This is a separate offset account. So
yeah,
yeah, that's
but it's a sub account from a
mm,
from a loan
Non-ADI.
account,
Yeah.
which is not non-ADI, and offset accounts allowable under a normal offset account or a true offset account is an ADI bank account. So most of the time, if you can't actually use that to buy that next property. So in that case, in that situation, the auditor flagged it, and we had to find a solution on how to deal with it. So there are two options there. You can actually go to the tax office and say, "Oh, I made a mistake. It's a real problem. Can you please forgive me?" The other option, which is what the client chose, which took a lot of maneuvering, was to actually put those funds back in the offset account. So
Mm.
thankfully, that deposit was not a large deposit. I think it was only a 10% deposit for the next property. And they were able to use money from outside of super and make a contribution back to the super fund and clear out that problem. So a word of warning around offset accounts inside SMSFs. The rules, with everything inside SMSFs, almost anything's possible, but there are rules.
That's what I wanted to clarify again. Was it a redraw or was it an offset? Because that's where the difference comes down most of the time. Redraw is technically yes, you shouldn't, but offset still is your funds, which is like you have
But
parked
it's
into offset.
the problem is the technicality of what an offset account is. So under
Mm.
the legislation, an offset account can, for that purpose of being able to draw out without those restrictions, needs to
Mm.
come from an ADI.
Okay. Got it. Well, something to be
Yeah.
cautious about.
What we're hoping for is, and there's a lot of lobbying by the SMSF community, is that it is recognised as an offset account and we won't have this problem in the future. But right now, it's not exactly a priority for the government.
Bigger fish to fry for them. Interest rates
Mm,
to hike. Uh,
yeah.
so yeah, is there any other stories that you can share about the consequences of what can go wrong that you would have faced because you deal with a lot of accountants and you are kind of a wholesaler to set up the SMSF for accountants and financial planners. So what have you seen the consequences and such horror stories?
Oh, you want more story time?
Yeah.
Um, so we talked about business real property as being one of our favorite strategies inside SMSFs, being able to lease property back to your business. Um, one one situation, and this comes up every now and again, is mixed use properties. So you've got maybe a shop at the front and a granny flat at the back, or you've got a retail shop at the bottom, and then you've got a home unit on top. Um,
Mm.
so the business wants to run their business from the shop or that business premises, that business portion, but they want to collect rent from the residential component of the property. But it's all on one title. It's technically not wholly and exclusive for business use because there is a residential component to it. And that's one of the big traps there. Even if that residential unit is leased to a third party, market rent, no problems there. It seems like it all seems very commercial. But that because you are leasing the commercial portion or that business portion to your own business, it's not, and it's not, the whole property is not used for business. You've actually breached the rules there. It's no longer considered business real property as a technicality.
Interesting.
Mm,
Yeah, something to watch out for. As we already know, it's a highly regulated space, so we just got to be careful of what we shouldn't do. We have a lot of questions now. Ashish, we should start taking them because we have quite a questions and I
Absolutely.
think we should.
So there's three questions in the question and answer section, and there's few in the chat. So number one, Achay asks, would it be better to set up separate SMSF for husband and wife?
ooh. Depends on your situation. What's the
Yeah,
relationship like?
she kick me out at any opportunity that she gets.
Um,
Hmm.
one of the great things about self-managed super funds is that it's so flexible. So there's a lot of potential different ways to carve it out, and so it really depends on your personal position. Um, the only reason, one reason why you wouldn't do that is costs, because setting it up costs. You're doing everything times two. You've got the setup cost times two, annual cost times two. Whereas in the end, if you're really just husband and wife and everything's mixed anyway, you can just have one and then share the costs. But
And that's what I've done as well. I believe the costs are halved then, because every SMSF account, I believe there'd be a yearly auditing cost and yearly taxation cost. So, Leanne, and there was a question around that as well. Since we're talking costs, can
mm,
you give an idea, just approximate idea on the cost? Because I do understand everyone charges differently.
Rahul
yeah,
has
so
asked this question.
yeah, it's an important one because it really does come down to whether it's viable to run a self-managed super fund. Each year, accounting and tax and the audits, it can range between 2,000 to 6,000 depending on who your provider is. Um, and then on top of that, you've got annual fees for the regulatory aspects. So you've got ASIC fees for each company you have. And the ATO charges a super levy because they administer your super fund. Um, so I generally tell clients that you budget $3,000 to $4,000 every year just these administration costs of maintaining accounts, tax returns, audit, ASIC fees, ATO levies.
Okay, makes sense. We also have a question from Prabhakar again, which is, does SMSF offer insurance like income protection and other benefits which are offered by the retailers? I do get that
Yeah,
from lender from my clients a few times as well, but you know, please go on.
yeah. So, so self-managed super funds, you can get insurances for self-managed super funds. You should speak to a financial advisor, which we didn't really talk about much today. A financial advisor, their role is besides helping you invest, not property, but other things. Um, they can tell you whether self-managed super fund is a suitable vehicle for you from a financial product perspective. But they can also help you with your insurances. So they can review your overall strategy, and you don't necessarily have to have all your self-managed super fund holding your insurance. You can A lot of people actually maintain a industry or retail fund and maintain that just for the insurances, because it's a lot simpler than having insurance inside their SMSF. So there's a lot of ways you can cut it, but definitely it is an option.
Look, if I share my experience, what I've done is I went to an insurance advisor and basically a financial planner. I took insurance from outside company and they deduct the money from the super. And again, don't quote me on it. The life and TPD comes from super. The trauma and income protection, I think, has to come from personal. So, but again, I'm unsure. I think that's where financial planner comes in because they'll advise what type of insurance, sort of insurance. And initially, I was maintaining one super between me and my wife, another super between me, my wife, my partner, and his wife, because I was told that
With
when
your
the
business partner.
insurance, sorry.
No, yeah, all good.
Yeah, because I
Yeah.
was told when the insurance money comes, you have to nominate an account because if you nominate a common account, then everyone has access to money. So there's just so many things going on, and that's where I brought in a wills person just to advise on it. But then, yeah, there has to be professionals associated with that.
Yeah, which kind of ties back together that you need a team when you run a self-managed super fund. So you got your financial advisor, your insurance specialist, an estate planner, because once you start building wealth, anytime we're talking money, you need to start thinking about um, those doomsday, that if you cross the road and get hit by a bus situation, who's going to get your all that hard-earned money at the end of the day? And you want to make sure it's going to the right people. And with SMSFs, there's a lot of flexibility when it comes to estate planning. So it's really crucial that you take that into account when you start building your wealth inside a super fund.
Works well. Thank you so much. And the next question has been asked by Ankit, and Ankit has asked two questions, and apparently both questions relate to using the money for, I think, personal things. So the two questions are, Leanne, number one, property on self-managed super fund, can you still negative gear from your private income? So I think it's just a thought process. But the
Hmm.
second one is, are we saying that if I withdraw equity, I can not use to pay my personal or car loan? So because both are related and it's both are asked by Ankit, over to you, Leanne. Don't get
Okay.
angry, please.
Okay, so let's go with that negative gearing from your private income. Um, so negative gearing inside super, so that's in one entity, and then you're talking about income in your personal name, right? So the only way you can reduce your personal income is and affect your super fund at the same time is to make contributions, deductible contributions. So potentially, if you haven't exceeded your or utilized your contribution caps, you can make a personal contribution into your super fund, which reduces your personal income, and then utilize your tax deductions inside your super fund from your negative gearing to then reduce um, to offset that negative gearing or that offset that income. So for example, let's talk tax rates. If you make an extra contribution and you get a tax deduction at 35% or 30% at that level, you get a tax deduction at 30%. Your super fund pays 15% tax on your contribution, but you've got all those losses to offset that. So really, your super fund's paying 0% tax, and you've claimed a 30% tax deduction. So yeah,
Also, yeah.
that could work. That could work. Um,
Interesting.
what was the what was the other question?
So
Um,
the other question was, are we saying that if I withdraw equity, I cannot use to pay my personal or car loan? And I'm assuming, but in SMSF there is no equity withdrawal
If you
anyways.
think this question is wild, wait for the next one.
Yeah,
I'm gonna ask the
okay.
next one. Yeah.
All right. All good then.
No, no. I'm just saying if you think this question is wild, wait for the next question that I'm gonna answer because one member has asked this anonymously. Yeah, I'll just ask that.
Anonymous.
Yeah, I'll ask the question after this.
Yeah. So look, I think it's from personal because you're not allowed to withdraw any equity from SMSF anyway. So we'll restrict our answers to SMSF only. So anyways, that's done then. It's not possible.
Well, the next question again is from Anonymous, and they have asked, can I buy a Rolex as investment and wear it? It's not a financial benefit, however, just enjoying the luxury.
Sorry, say that one again. Can I
Can I
buy?
buy a Rolex watch as an investment and wear it? It's not a financial benefit, however, just enjoying the
No. Simple answer.
luxury.
You as soon as you said that, it's you can't wear it. So with any collectible, it needs to be stored away from your home. It needs to be insured within 7 days. It needs to be revalued every year. So you got to think of this. This is an investment here. Um, so, and as soon as you put it on your wrist, you've actually taken a benefit from your super fund. You can't do it. Yeah.
Well, that answers that question. I think they knew before we answer the question. But the next question I think is for Ashish. What can we buy for 800,000 in Sydney?
Mm.
That lovely view for about 860 at 4% net returns. Um, but look, Sydney is very difficult. Again, it depends. I won't be buying apartments if I'm looking for growth. A lot of people feel apartments are safe options to buy if you're compromising on growth. Yes, they are, but they are equally way better investments. But talking what we can buy in Sydney, I'd say nothing. You can go to Campbelltown and find some really old homes. Again, that goes against the low maintenance aspect. And then you can look at Newcastle markets. That's a hot tip. So, plus you can go regional. So if we don't talk Sydney, we talk New South Wales. There's Albury, there's Wagga Wagga, there's border around Mildura. There's ample markets in New South Wales, Orange and Dubbo included. So, all right, I'll skip that question. We'll again come back to SMSF questions. Jatin asks, are all the property expenses, example repairs or council bills, paid from SMSF balance? So I also have this question, Leanne. I know what I try to do is I ask the property manager to pay all the bills because then that will go from the rent. And then at the end, when I get a financial year statement, I don't have to go to my accounts to check what payments I've done. However, let's say if there was a big payment, like maybe a supplier has to be paid about $2,000, 3,000, or insurance, which is $1,500, and it cannot be taken from the rent, can I pay it through SMSF?
Yeah, so all things relating to a property related that's inside your self-managed super fund should come from essentially SMSF money. So whether it be the rent that the property manager is holding in their trust account or in your self-managed super fund's bank account, so you pay it through your SMSF bank. And sometimes you get into a bit of a situation where neither of those accounts have cash. What do you do then? So I've been asked this question before. Can I use my personal money and pay that bill? And while it is possible to pay the super fund's property bill with your personal money, it can go two ways. You either have to reimburse yourself really quickly, so it doesn't look like you've just borrowed money, or you call it a contribution. So you you're effectively injecting funds into the super fund by paying an expense on behalf of the fund.
What does really quickly means here?
Um, well, really quickly usually means within a couple of days or up to a week. That's the unwritten rule. But don't quote me on that. It is a very murky grey area. But it's, I guess, it's defendable.
Got it. Now, once Ajay has asked, once the 3 to 4 thousand is paid and to set up an SMSF, what are the ongoing costs that they should be prepared for each year? And in terms of audit and other compliance requirements, so basically they're asking what are the ongoing costs, which we I think answered the question earlier. So you should be prepared
Yeah.
to fork out 3 to 4 thousand. Is it
Yeah.
each year? Okay.
Yeah.
So Ajay, that's the answer to that.
Um,
So Sheila
can
has
I add?
asked, sorry.
Can I
Yeah,
add to
absolutely.
that?
Sorry. Yeah.
Yeah. So if this, I think this relates to things that are unlisted, so they're not ASX listed or stock market listed. Be prepared to pay for valuations. So each year, when we prepare financial statements, you need to have all your assets revalued or at least assess whether the current valuation is appropriate. So if you've got things that are not regularly traded, you may need to get a qualified valuer to come in, and that incurs costs. So a residential property, usually there's a bit more movement around that, so you might get a desktop valuation. But things like business real property, commercial properties, where they're a little bit more unique, you may need to go get a valuation done, and they can range. Yeah, so be prepared for that too.
Good answer. Yeah. So this is answered. What's the next one?
So Sushil asks, is there a way you can include the insurance that you have on existing super covering under SMSF as well? I believe we have discussed, but um, Leanne, I don't think it's the same insurance. You would have to go with a different insurance provider through a financial advisor.
That's right. That's right. You can maintain your existing insurance. You don't have to have just one super account. You can have multiple super accounts in different forms, whether it be self-managed, industry or retail funds, or even a specific superannuation insurance fund. Um, so you can maintain that, especially if you've got pre-existing conditions. You don't want to touch that insurance. So
Spot on.
definitely speak to an insurance advisor before you go start moving things around in that space.
And as the age progresses, the uh, requirements get a bit stringent and the premiums get a bit high. So you have to be very cautious. So very rightly said. Thank you so
Mm.
much.
Next question is about lending, which we already discussed that you can do less than 80% LVR. Oh, sorry, more than 80% LVR. You can go with 10% deposit as well, plus the stamps, everything. So that answers it. Retail super funds, Mahesh Babu has asked, often deliver around 8 to 10% returns. Given that, what is the advantage of moving to an SMSF and investing in property instead? What is the average returns you expect if you invest in property via SMSF? And again, I think we discussed that. It's about the leverage
Rahul,
that.
can I explain in a very simple concept?
Sure,
So
absolutely.
let's say you've got about $30 in your super. At 8%, it's $2.4 that you earn a year. If the same 30, and that's about 8%, right? And let's say the same $30 are used as a deposit in property and one-time costs, and you take $80 from the bank. So what we've done is $20 in deposit, $10 in one-time costs, stamps, buyer's agent fee, whatever costs are there, and $80 are given by the bank. Now, property conservatively would grow at 6% year on year. It grows a little bit over and above as well, but I'm taking a longer term average. RBA stated average is about 7.25%. So 6% is still a lower figure, which means on $100 property, you're getting now $6 return year on year. So of course, not including the holding costs at this stage, but your cash on cash return on $30, you get $6 return, which becomes a 20% cash on cash return. So that's a very simple sort of analogy on how you can figure out or why even people look at property in the first instance, or what was my reason. My reason was business and now the growth aspect. So anyways, back Rahul to you.
I was just saying that this is exactly why we also have the question of stocks versus property and why property is performing these days way higher than stocks. A lot of the people do prefer stocks to diversify. And again, speak with the financial planner. Before you speak with the financial planner, understand what is their strategy is, what is their incentive, what are they suggesting, what they are getting out of that. Are they getting the same returns by recommending you property? Probably not, because they have some whatever commissions, fees, and obviously they should disclose it to you. They do disclose it to you, but that's why that often comes down as a more preferred way of advice for investors from financial planners. So bear in mind that point when you have a discussion with them and ask them this question. I think Leanne also discussed that briefly with me and mentioned to me why certain financial advisors recommend stocks over properties and other investment options.
Yeah. So financial advisors, they're very restricted on what they can and can't talk about as well. So just like us, we've been in our fields, we know our field, and that's all we know, and that's all we're allowed to talk about. Financial advisors also have that same thing, and they can't, a lot of them can't talk about property or things that are, or asset classes that are outside of their realms, like cryptocurrency, collectibles, and property. Um, One thing I would, this is just me, because I love talking and understanding how people's businesses work, is ask them, how do you invest for your clients? What is your investment methodology when you speak to a financial advisor and you're planning on diversifying outside of um, whatever it is you're investing in? Because different financial planners have different strategies within the financial planning world. So some love going direct into markets, some prefer funds, some prefer ETFs. So find someone that you're comfortable with, that you actually understand what they're saying. And to me, that's the most important thing for all professionals that you work with. Speak to someone that you feel comfortable and you actually get what they're talking about.
Someone who's actually done that. If they
Mm,
have not dealt with property, and if they are recommending not to buy property, you know why they are not doing this, because they personally have not done much in that. Speak to someone who might have done this and that, and then coming from experience, you have to ultimately make the call. Bear in mind not to overrule any financial planner's advice, because they are very smart people and they understand
mm,
money more than the rest of the people
And
who are not qualified.
and that's the other thing. I think red flags would be a person in property pushing you to SMSF. It's not their advice to give. A person in financial planning pushing you to a house and a land package. It's not their advice to give. And again, I'm not sure about the allowance and things like that. So always it pays off to be prepared and um, have that knowledge. A lot of people trust other people, so it's not to break the trust, but it pays to be a little bit prepared. So at least you know the professional is not taking you for a ride. So Leanne and Rahul fully concur with that.
mhm.
Let's just keep this moving because we don't have questions
Absolutely,
to
yes.
cover.
Let's keep
Yeah, we
going.
could talk
So
forever.
absolutely, this can go forever until retirement, but let's just not stretch it that far.
So
We have the question, which is sorry, go on. Yeah, Ashish. I'm lost
yeah,
where the question was.
no, Amol asks, what area or state do you recommend for buying a commercial property, and same for residential property? Look, it's Australia wide. For commercial, wherever the numbers make sense. For residential, depends on strategy, budgets, but wherever the market is growing. We've got ample other webinars that talk about property. So I'll move on to the next one, which is asked by Sushil. If you buy one investment property under SMSF that has grown up generating some equity, can you not draw down to buy another investment property under SMSF? Do you actually have to sell and purchase another one? Can go to either Leanne or Rahul. Equity withdrawal.
I mean, you can't do the first part. We discussed that. For the second part, depends on your strategy. Again, that is a property and your overall strategy sort of a question. So if you feel like the property has done enough, now you can pull out money after all the holding cost, selling cost, CGT, whatever remains. If you can use that money to get more returns out of that than your current property is providing, that's when you should do it. So that's not an SMSF related question, just your normal everyday opportunity cost related sort of a question, which again, property person like Ashish can, crunch the numbers and tell you an answer for.
Works well. Sagar asks, what component of development property can be funded by super? Land
Cannot be funded by.
acquisition.
Sorry, I'm
So
just correcting the question.
say, say it again. Cannot be
Yeah,
funded. Cannot.
yeah.
Yep. So what component of development property cannot be funded by super? Land acquisition can be funded by super, but other costs, consultants fees, DA, etc., can that be funded through super? Leanne.
So if you've got the cash inside your super fund to do all this, then yeah, you can definitely go and fund it through super. But most people don't have that kind of cash to then go buy that land, then pay for the DA, then pay for the construction and all that sort of stuff. So it's it's yes and no. You can't finance it, but you can use your
Neutral.
super money to do it. Yeah.
Awesome.
Negative gearing. I think we covered the negative gearing. Did we cover this question? Just on negative gearing. If I purchase a property through my SMSF, will the funding be cash flow positive? I don't think no, not for the first few couple of years at least.
I think
If the rent
Leanne
goes above
covered
the
it
value.
well.
Yeah, okay, think we did cover that.
Yeah,
Are we saying that? So, yeah, again, personal loan, we covered that. Ashish,
yeah.
I think this one is going to be for you. Vinay has asked pros and cons buying residential versus commercial properties under SMSF.
I think it's very in a general sense as well. But I believe in SMSF versus outside of SMSF, residential property rates go up, but commercial property rates come down. Then the yields on commercial properties are better. They provide a better cash flow. They are low maintenance because the tenant is paying your expenses and all the outgoings. Residential definitely has holding costs. They grow better because the money is tied in the equity. Um, a risk can be vacancy. Residential has very minimal vacancy. Commercial can have higher vacancy. So you may be up for decent holding costs if you bought it empty, or if you bought off the plan, you may be attracting GST, which is 10% of purchase on top. Like I bought this office for 860, I paid $86,000 in GST. I did not take that into account. All right, so don't judge me on that because I was prepared to put a lease on it. However, I still had to pay GST. You can claim it back in the next quarter, but you have to be prepared to pay $86,000, which was a very decent amount.
Mm.
Anyways, coming back. So that's what the difference is. All right. So again, Amol asks, how's Newcastle for a commercial property investment around $1 million mark? It's not a bad market if you can get the right property. The problem is in commercial finding the right property with the right returns. New South Wales has lower returns comparatively, starting 4% to going up till 5.5%, which are very, very hard to find. But yeah, it's not a bad market. And it has a very decent commercial precinct. So, all right. Ajay says, thank you for answering all the questions. I'll move to the question and answer tab.
Just
Now, the
two more now. Again, I think this came from the Rolex guy as well, and I think anonymous again. They have asked if they can buy a rare Charizard Pokemon card, which can be considered as an investment SMSF. I think,
asking for a
yes,
friend. He's got very
Ah,
asking
good
for a
friends, I
friend.
tell you.
Is your friend Ash Ketchum?
he's been
Actually, that's an
watching.
investment. That's an
Yes.
interesting question, though.
It is a collectible
Yeah,
thing.
it is a collectible, so there are strict rules around that sort of thing. You wouldn't be able to keep it in your home.
Oh,
So the same rules apply for that Rolex that we were talking about before. Uh, so it needs to be stored away from the home. Usually something like that would be inside a safety deposit box. It needs to be insured within 7 days by the super fund. So the cost of that insurance as well is going to factor into that purchase. Um, you can't you could probably you could probably view it to ensure that it's still there, but you can't go and like take it around and I don't know, what do you do with a Charizard? A rep Charizard card. You wouldn't trade it. You wouldn't play it. But you would also need to go get it valued every year too. So factor in those things too. But it is possible. It is possible.
Hmm. Yeah, don't personally use your choice and don't fly on that. That is the answer for your main question. We have another good question from, I think it's anonymous as well. If you were structuring an SMSF today purely for long-term arbitrage, what would
tax
you avoid
arbitrage.
doing in 2026? Tax
Uh,
arbitrage, is it? Yeah, tax
yes.
arbitrage, sorry. So, Leanne, quite loaded. Do you think you can answer that without knowing the details?
Well, tax arbitrage inside with your SMSF and including that is what we were talking about, personal contributions and um, to a certain extent you could do this with a company paying rent, business rent to a property that's owned inside your super fund. So a business that's um, being taxed at 25% pays rent to a super fund that's paying 15%. So you're saving 10% straight away. So they're the sort of things that you could potentially do with SMSFs. But like I said, with the contribution side of things, you could easily do that without an SMSF and do it with an industry or retail fund too.
And the
Amazing.
last question. is, can we go from SMSF back to Australian Super after selling all the investments?
Yes,
Interesting.
you can wind up your super fund. And there are many instances where it's very much appropriate. You've kind of go, you no longer want your SMSF. You decide to move overseas because you must be an Australian resident to have your SMSF. Um, or you've come to the point where you actually just it's a natural time for you to close it down. So definitely possible. But you still need to go through that whole process of accounts, tax returns, and wind up and roll over. So bit, it's a bit clunky, but it can be done.
There's a lead up question to that. After retirement, can they move to a different country and still hold the SMSF trust? What about the tax implications?
Okay. To maintain your self-managed super fund as an Australian super fund, it needs to be controlled. The central management and control needs to be in Australia. So if you go overseas, you need to put some legal structures in place or implement a strategy where someone's in Australia maintaining your super fund for you. You can still take the benefits of it, uh, but someone else will be in control of your SMSF.
Perfect. Yeah.
Well,
All
there's
good.
one question
Mhm.
left, which is the booming next hotspot according to you? Um, so
I'm going to get my pen ready for this.
look, I would have to kill everyone if I tell that. No, just no.
Yes.
Look, you've taken the
Let's
pain to
reveal the
stay
hot
there for
topics.
nearly 1.5 years or 1.5 hours. So, um, depending upon the price point, I really love the pockets around the Badgerys Creek Airport for Sydney. I love the Newcastle markets. Um, then going to the growing states. And while these markets are pretty strong, the regional New South Wales, regional Victoria, and Metro Victoria are growing really strong. Last year, on papers, Victoria went up by 3.3%. On ground, Victoria went up by 8 to 15%. Because we bought really well some of the properties. We started buying in October 2024. Um, and in a year's time, I've seen some properties go up by about $90,000 and that's the beauty of knowing what's happening on the market. But you have to be very careful. Um, you have to be very selective with what suburbs you buy. It's unlike Perth and Adelaide, where it doesn't matter. You throw a dart, buy there, and it'll grow. That will is not going to happen. Um, I've seen some traction going into Tasmania market, and we are now building up partnerships there. And I've started the research as to what suburbs we need to look at. Um, like my personal investment style is looking at the demographic more importantly, and I look like a newsreader. Anyway, so I, I like the demographic. That's my personal investment style, and that's reflective of what cl our clients purchase as well. But knowing the risks is really important if you go into Tasmania markets as well, and so does Victoria markets. So that's what the hotspots would be. Since 2017, it has consistently paid off the sort of returns we are making in property. I'll give you just two examples. There's a single mom that we supported to purchase a property for $420,000. She recently sold it for 810, and with the deposit with a partner, she was able to buy a small townhouse in Warunga. Um, Second example, there's a low income earning couple, and we bought a property in Perth again for $460,000. Their latest valuation is 820. So property is renting for about 680 a week. They're withdrawing the equity and buying two properties. So yeah, there's been some really consistent examples since 2017 with Victoria at that point, moving on to Adelaide, Perth, and now going back to Victoria, Sydney, regionals, and to
Look
Tasmania.
everywhere.
All right, that's it.
Perfect. Now, all good. Thanks for joining, and thanks for joining everyone.
Amazing.
It was really educational, and for everything related to SMSF, we will send a detail email with Leanne's detail as well. Feel free to reach out to her for SMSF setups and all the queries and questions and inquiries about that. And thanks for joining, and we should wrap it up. here now.
Amazing. Thank you, everyone.
Thank
Thank you.
you.
Good
Okay.
on. Thank you.
Yes, bye.